called as procedures. So,
one of the words that we have heard along with the test of details and test of controls is the word analytical procedures. Substantive analytical procedures is something that we have been hearing and hearing. So just remember that whenever you use the word audit evidence, there is a adjective added to that: sufficient, appropriate, relevant, and reliable. When it comes to something like analytical procedures, you add the word substantive. Substantive means independent, something that can, independently verify the results in irrespective of the details that are there in front of you. Think of misstatements. It is not a simple misstatement. It has to be material. So material misstatement. And similarly, you have all these words where they bring out a specific meaning to that particular terminology. So whenever you're reading any audit related chapters or books, try to have those adjectives in mind. Whenever you come across the word analytical procedures, the very first thing that has to come to your mind automatically is substantive analytical procedures. Substantive analytical procedures. Keep repeating that so that you have that word in mind. What is substantive? Something that can be done independently. We have test of details, we have test of controls. Test of details and test of controls, how will you evaluate? Based on the documents that are given to you. ஒரு வவுச்சிங் பண்றப்ப நம்மளுக்கு இருந்த டாக்குமெண்ட்ஸ்ல வந்து டெஸ்ட் ஆஃப் டீடைல்ஸ் அப்படின்னா அதுல இருக்கிற டீடைல்ஸ் எல்லாம் செக் பண்றது, அமௌண்ட், அதுக்கப்புறமா அக்கௌண்டிங் ஹெட், அதுக்கப்புறமா வெண்டர் டீடைல்ஸ் செக் பண்றது, கிரெடிட் பீரியட் செக் பண்றது, இதெல்லாமே வந்து இட் இஸ் டெஸ்ட் ஆஃப் டீடைல்ஸ். அக்கௌண்டிங் என்ட்ரி செக் பண்றது. டெஸ்ட் ஆஃப் கண்ட்ரோல்ஸ் அப்படின்னா என்ன? அந்த டேர்ம்ஸ் அண்ட் கண்டிஷன்ஸ் வந்து கரெக்டா இருக்கா, நம்ம டேர்ம்ஸ் அண்ட் கண்டிஷன்ஸ் கரெக்டா இருக்கா, அதுக்கப்புறமா இது யாரு அப்ரூவ் பண்ணது, இது how was it released, how was it approved, how was it accounted, based on the accounting and the approvals இருக்கா இல்லையா. So all these things is test of controls. So if it has a due date, and the due date kulla payment pocha illaya, payment vandircha illaya, so all that becomes your test of control. Now apart from this, independently, if you can carry out some procedures, substantive, independently, without support on these documents, if you can carry out any analytical procedures, that would be your substantive analytical procedures. So what exactly is the meaning of substantive analytical procedures? Abdina, evaluation of financial information through analysis of relationships. இது பார்த்தாலே உங்களுக்கு first thing that should come to your mind is ratio analysis. Analysis of relationships. That means ஒரு நம்பர் இருந்தால் அது வந்து இன்னொரு நம்பருக்கு கம்பேர் பண்ணா how and what information are we receiving from it. Let's take, we are comparing the sales information with the expenses. Compare பண்ணா, direct costs compare பண்ணா, we are coming across something called as the gross profit, and then we are comparing with all the indirect expenses, then we are coming across something called as net profit. I'm sorry, I hope I'm audible, right?
Yes sir.
Okay, great. So in the comparison வந்து நம்ம you can do it in various ways. You do sales, compare with the assets. You have net assets, sales to net assets ratio. You have sales and equity comparison, that is a return ratio. You have sales and cost comparison, you get the gross profit, net profit. So like this, depending upon where you are comparing that number, you can get one particular type of analysis out of it. Now, not just comparing with different numbers, you can compare it with its own number. That means sales இருக்கு, இந்த மாசம் சேல்ஸ் இருக்கு, அடுத்த மாசம் சேல்ஸ் ப்ரொஜெக்ஷன் இல்லனா லாஸ்ட் மந்தோட சேல்ஸ் ஆக்சுவல் சேல்ஸ் கம்பேரிஷன், ஆர் லெட்ஸ் டேக் ஃபினான்ஷியல்ஸ்ல நம்ம எப்படியாவது கொடுப்போம், we give comparison with the previous year financials. So 1 year comparison, this year results எப்படி இருக்கு, last year results எப்படி இருக்கு. So this is evaluation of financial information through analysis of relationship. When you have a financial information, when you have numbers and data, you can obviously do this comparison through ratio analysis or just normal subtractions, additions, and see what exactly that information gives you. What picture does it give you? So that analysis is basically your analytical procedure. So next they say this could be done among both financial and non-financial data. So what is financial? What is non-financial? Financial is something to which you can give a number, and non-financial is something to which you cannot give a number as of now. ஒரு provision இருக்கலாம், ஒரு disclaimer இருக்கலாம், ஒரு disclosure இருக்கலாம், notes to accountsல details இருக்கலாம். So based on that, you can see last year வந்து என்ன disclosure கொடுத்தாங்க, இந்த வருஷம் என்ன disclosure தராங்க. So based on that also, if you want to compare, it can still be considered as an analytical procedure as long as there is something to compare. That is important. ரெண்டு number, ரெண்டு information, either ரெண்டு number or two information has to be there for this comparison to happen. It could be financial, it could be non-financial. Further, they are saying it could include such investigation as is necessary of identified fluctuations or relationships. So not just comparing those numbers, அந்த நம்பர்ஸ்ல வந்து நம்மளுக்கு ஏதாவது fluctuation இருக்கு அப்படின்னு தோணுச்சு அப்படின்னா, we can also do the subsequent analysis. And the subsequent analysis is also considered as analytical procedures only. Since you are pulling the chain, or information நம்மளுக்கு கிடைச்சிருக்கு, you are just trying to pull the chain and see how long this goes. So let's say gross profit வந்து 80% வந்திருக்கு, but net profit is only 40%. See, you are able to manage your direct cost. Direct cost is generally the place where you have the maximum amount of cost. Ideally, let's say in the manufacturing sector. So direct cost is where the major expenses for the manufacturing sector. But if you are seeing a 40% going off in the indirect expenses, you need to evaluate what exactly is contributing to that. Why there is so much of indirect expenses? So what is keeping the direct expenses low? What is keeping the indirect expenses low? So one possible analysis is that we have one company where the accountant keeps fluctuating the numbers between direct expenses and indirect expenses based on the results of that quarter. So அவன் என்ன பண்ணுவான் அப்படின்னா, if one quarter, if it is favorable, if the result is favorable, he will put most of the things in the direct expenses. If the result is unfavorable, he will push the expenses to indirect expenses so that he can show higher contribution. So this is something that we keep fighting with them. So, and then when we present our results, it will always be consistent. It has to be consistent. That is one of the major applications of the accounting procedures and also the presentation. You need to be very consistent with your presentation to the management or whatever the end user is. Otherwise, they will not be in a position to make a right decision. So we keep correcting based on the actual way it should be presented. So in case we identify any deviations, let's say there is this 40 percentage was there last month. This month we have seen a 60 percentage indirect expense. What exactly is contributing to this increase? What exactly is driving these changes? Last year, COVID learned the electrical consumption expenses compare பண்ணிட்டு you take this year's electrical expense comparison, you will definitely see a huge fluctuation, but those fluctuations also will have some meaning beyond them. There is a minimum charge that you are incurring. What is the minimum charge that you are incurring? What is the minimum amount of money that you need to spend towards it? What are the incentives that you have received? All that analysis you can do and see if these numbers are representing the fair or accurate representation of the actual scenario that has happened. So analytics is not just identifying or comparing the information, it is also analyzing or investigating that compared information, the result of that compared information. Let's say or 50 percentage is the sales in comparison to the net assets or total assets. Then we need to understand what exactly does this number represent. So அது வந்து we try to analyze further. If it is able to generate 50 percentage of the equity, it's a great thing. You're able to generate 50 percentage of your equity as a sale. It is obviously a great thing. But if you are losing out a lot on the direct expenses and indirect expenses, and you are retaining a very marginal 1%, 2% amount, then you really need to consider your business, because you're able to generate half of your equity in one single year, but you're not able to retain enough profit into the organization. That's something that you really need to think of. So all that subsequent analysis based on the initial comparison also is a analytical procedure. So identified fluctuations or relationships that are inconsistent with other relevant information or that differ from expected values by a significant amount. We expect the direct expenses to be in this range for this particular industry, but it is higher or lower. You need to analyze the indirect expenses or utility expenses. We expect it to be this number. So sometimes it so happens that even though the numbers are random, if you compare them with the sales, or if you compare them with the contribution numbers, or if you compare them with gross profit numbers, you realize that there is a almost a fixed percentage that is generally arrived. So material cost of goods sold, we were analyzing one company yesterday. So where across the last 10 years, if I have taken the data, the cost of goods sold was coming exactly around 86 to 90 percentage. So that's the range that you're looking at, 86 to 90 percentage. And by taking the closer, let's say by taking only the last 5 years, we were getting somewhere around 88 to 90 percentage. So you can have that in mind, saying, okay, if there is going to be a result next year, I'm looking at this block 88 to 90 percentage. So just you can keep a round figure in your mind, saying 90 percentage is what I'm looking at. If there is a subsequent substantial deviation from that, let's say it is 94 percentage, 92 percentage, or if it is 86 percentage, then I need to analyze as to why this deviation has occurred, whether positive or negative. There has to be some logic behind the deviation. Every deviation must be supported by some logic. So let's say your substantial production purchaseல வந்து deviation வந்திருக்கு, or let's say instead of from retailers they have moved to wholesale purchases. So these things can definitely impact your top line, as in not just the top line, your cost of goods sold also. So based on this you can do subsequent analysis. So either it is consistent with other relevant information, or it is differing from a expected value by a significant amount. Inconsistent with other relevant information, just keep depreciation rentals in mind. It has to be 20% depreciation. Just see if the amount is tallying up to 20% or not. Then next one is the audit procedures. Audit procedures la vanda they say there are two types of comparisons that are possible. One is consideration of comparisons of financial information with comparable information for prior periods. Like I said, the same item you can compare it with previous periods. Sales FY 2020, FY 2021. Gross profit FY 2020, FY 2021. Net assets FY 2020, 2021. So like that, if you compare the information with itself during the prior periods, then it becomes a comparison. Next, anticipated results of the entity. So what are you comparing? You're comparing the actual information with anticipated results, basically your budgets. So this was the forecast that was there, or this was the budget that was prepared. Budget is past and forecast is future. Budget என்றது வந்து it is prepared even before the financial year starts. It is prepared even before the financial year starts, and forecast is prepared after the financial year starts. Maybe futureல வந்து இப்படி இருக்கலாம் என்ற ஒரு analysis தான் it is a forecast. So let's say you have a budget of 1 lakh, but your expenses have gone up to 1,50,000. Then when there is a budget of 1 lakh, if the expenses for 1,50,000, obviously they need to have additional approvals for that 50,000. Please understand that if any of the ledgers exceed the budgeted amount, there has to be approval in place for exceeding the budget amount. I have seen in project management specifically that the software itself will be coded with the budgeted amount. So once the budget is finalized, the IT guys will be given the budget numbers. And what they will do is they will fix those numbers for the year in the software. Now what happens is whenever there is a PO that is being placed, it shows you how much of budget is there, what is the total budget, how much of the budget is used, how much of the budget is pending. So let's take the example of 1 lakh. Now you have completed 90,000 of the budget. Now you have a new PO for 60,000. It will not let you create the PO because there is only 10,000 rupees of budget left. So you cannot create a PO of 60,000 rupees. Okay. So in case you want to exceed these budgets, there should be a management approval in place, because for the IT department to edit the budgets, the management has to say that, okay, though this was budgeted, the actuals are going higher, so it's okay. We are aware and we understand that this is required, so increase the budgets. So subsequently, there will be a revised budget and the number will be increased to 1,50,000. So similarly, there could be forecast. Forecast is there was a forecast of 2 lakh sales in the month, but you could do only 1,50,000. You could do 2,50,000, or you could do 2,20,000. So higher or lower, you can do that comparison. Next is auditor's expectations. This expectations basically means, like I said, let's say take any expense for that matter. Just say you have salaries. Okay, salaries generally most of the industries you look at, around 30% of the cost goes in salaries. Now there was one analysis that we were doing yesterday, where we were trying to look deeper into the salary, because the salary cost was very high for that particular organization. So we were trying to figure out what exactly is really driving this salary to be so high for these people. So we saw that it was somewhere between 40 to 50% of the total revenue in the organization, and that's a very huge number. Okay, salary being 40 to 50% of the revenue is a very huge number. So we were trying to understand. See, initially we compared the information, we compared the sales and the total revenue, and we got some information: 40%, 42%, 45%. This is the numbers we got. Now, when we are getting these numbers, we need to dig into it further and see why it is so high. And then when we took the breakup of the salary and we analyzed, we realized that the cost centers are actually having a higher salary. That means there are profit centers, there are cost centers in an organization. Let's take profit center அப்படின்னா actual production இல்லைன்னா actual operations வந்து profit center, because they operate and generate the goods and services required for the sales. So they are not just support activities, but they actually generate the revenue. And what are cost centers? Cost centers are basically those which are purely incurring cost but not generating any revenue. So take the example of HR, take the example of audit, take the example of accounts. Sorry. Take the example of admin. These people are basically support functions and they do not generate revenue. So when they are not generating revenue and you have a substantial amount of salary coming from them, that definitely means that you're not fully utilizing those employees. You're not utilizing the potential of those employees. So because of some conflicts and goof ups in that organization, what has happened is, if salary of accounting is 50,000, the salary of all the staff combined together in other operations was 50,000. Just imagine 3-4 people sitting here in accounts is having 50,000 salary, and all the other people combined in operations is having 50,000 salary. So that is a significant deviation, right? Instead, you can give these salaries to those operations people and really boost their morale, and that will really push them towards a higher production. So these things are what you need to come out with. So once you are comparing and then you have some analysis done, there will be something for you to report on. So the auditor's expectations, Dina, some numbers must be in this range அப்படின்ற ஒரு analysis. So say roughly production எவ்வளோ இருக்கு அப்படின்னு கேட்டா, சார் 1 lakh tons per month ஆவரேஜா வருது அப்படின்னு சும்மா ஏதோ ஒரு டிஸ்கஷன்ல சொன்னாங்க. பட் டோட்டல் டன்னேஜ் வந்து டோட்டல் ப்ரொடக்ஷன் யூனிட்ஸ் பார்த்தா ரிப்போர்ட்ல இட் வாஸ் அரௌண்ட் 15 lakh டன். எப்படி ஆவரேஜ் 1 lakh இருந்தா 12 lakh தான் வர முடியும்? ஹவு தேர் கெட்டிங் 15 lakhs அப்படின்னு அனலைஸ் பண்ணா they have included non-core. And that means they have included other products also which are not their main core business. Just a minute. They have included products which are actually not part of their core operations, and they have included them as units, because of which it was showing as 3 lakh extra units, and that was not the reality. So expectation under the one, maybe because of the information you received or because of the experience that you have, certain numbers when you see, you know that this should be in this percent range or this should be in this number range. So that is your experience. That is where your experience lies as an auditor. So when you are doing that comparison of information, when you're trying to look at those numbers, you have to develop that sense of the numbers and see and say, okay, this is what was supposed to be expected, but this seems to be a little deviation. So even though the numbers are not speaking to you, you need to try to create or develop that mind where you can analyze the numbers just by looking at them or looking at those percentages and saying, no, this cannot be. This cannot be. We have one manager in the office who just looks at those numbers. He doesn't review the report. He, whenever we are going to submit any critical reports, we just ask him to have a look at it. So what he does is he just looks at the numbers and he gets this feel of those numbers and he says, no, I feel this number is not very appropriate. So most of the time it so happens that some of the other assumption was incorrect with respect to that number. So that's the level of understanding that person has with numbers. So that's what auditor's expectation is. You need to create that sense or uh, you know that logic for that number and say this is what it should be. That is what is your auditor's expectation, and that comes with experience or similar industry information. So like I said, salary is generally in the 30% range. This is experience. Now the industry says it should be somewhere in the 20% range, or it should be somewhere in the 35 to 40% range. So based on the specific type of industry also, you need to define your analysis. So comparable information under the one, the either prior period, so the same number comparing it with prior period, or anticipated results, the same number being compared with budgeted number or forecast number. Then you have auditor's expectation, that is your sense. This percentage is correct, this number is correct, in the quantity is correct, in the analysis, based on your experiences, based on your observations, based on your logic, you feel something is wrong with this number. That is what your expectations are. You expect a certain number to that particular line item. So that is your auditor's expectation. And then similar industry information. So the bonuses for the year were 30% in the industry, but you have given a 20%, you have given a 40%, you have given a 50%. So that will definitely have an impact on the other variables. You need to try to understand how they could give 50, how they could, why they gave only 20. All that analysis is to be done. Next, comparison, consideration of relationships among. So one is financial information comparison. That is directly you're looking at comparison of the data numbers that is forming part of the financial statements. Next is consideration of relationships among elements of financial information or financial information and relevant non-financial information. That means, how are these two numbers varying? See, sometimes we may not really have this mindset to compare two different data. You in costing also you have this called I'm not getting the exact word for it, but I'm not getting the exact word for it, but when we do variance analysis, we have these numbers which move along with the other number. That means if revenue is increasing, the material cost also should increase. If revenue is decreasing, material cost also should decrease, because there the sales are not happening means parallelly the purchase is not happening, so the sales is not happening, isn't it? But if the sales are not happening and you keep purchasing, that does not make any sense. So that is establishing of relationship between financial information. So the sales and cost of goods sold, the material cost, you are able to establish a relationship with them. It is direct relationship. That means if sales is increasing, the material cost also must increase. If the sales is decreasing, the material cost also must decrease. You cannot have any other go. It is impossible to have any other go. It has to decrease. If it is not decreasing, definitely something has happened in that organization and it is worthy of reporting. Take something like utility. Utility is definitely linked to your production. Based on the amount of production you do, based on the hours you work, based on the number of days you are working, based on the peak hours that you are working, definitely your utility is varying based on that. Utility abdina electricity expenses, rental expenses. You have all these water expenses. All these basically are your utility. Communication, telephone, internet, all these become your utility. So some numbers have a direct relationship with the sales. Some numbers don't have a direct relationship with the sales amount. So when you are doing that comparison of this information, it basically is your financial information comparison. You are considering a relationship between two financial informations. Now come to the non-financial information. Now let's say இப்போ ஹியுண்டை நேத்து என்னாச்சு, பாகிஸ்தான் ஹியுண்டை வந்து ஒரு ட்வீட் போட்டாங்க, வி சப்போர்ட் ஃப்ரீ காஷ்மீர் அப்படின்னு. உடனே the Indians reacted and Hyundai is down by 38% in terms of the stock market. You cannot hit 38%. I heard there was a 38% drop in the daily sales. So this is definitely going to hit them in the long run. Now, what is happening is there is a non-financial information. There is a tweet that has happened by official body of a company. Okay. Now, this is a non-financial information, but it has resulted in a sales drop. It has resulted in a investor, the stock price drop. So how exactly is this non-financial information affecting the financial information? How is this tweet affecting the stock price? How is this tweet affecting the sales of that entity? Not just the sales, it is also affecting the net assets also. That is the net equity. So how are these effects happening? What exactly is the impact of that on the organization? இதுவும் analyze பண்றது becomes your analytical information. So non-financial information is basically the news that is available in the market. Let's say some months you suddenly see a spike in the sale. So one particular organization, what we had seen is suddenly there was a spike. All these years they never hit that level at all. they never ever hit that level. And suddenly we see a spike in the numbers. And we try to analyze, and what we had realized was first 2-3 months it was actually a real spike because of the what is that, some change in law and regulation. Because of that, it has benefited these people, and there was an actual spike in the sales. Now what has happened is after 2-3 months it has become again a normal scenario, and the sales were supposed to drop, but even after that the sales were at the same level. So this was confusing, because when there is a change in law, you have an increase in sales. It is understandable. It is the law, change in law is impacting your sales. It is boosting your sales. It is profitable change for the business. But when after 2-3 months, when the conditions changed and the law was modified again, or when something happened after 2-3 months where the conditions returned back to normal, in that case obviously the sales also have to return to normal. But in this case, company's case, the sales were not returning to normal. So when we did a deeper analysis, what we had realized was management got used to seeing those higher numbers. So what the CFO was doing was, he was simply creating unearned revenue. He was simply creating provisions just to project a higher sales number. Just to project a higher sales number, he was just creating that provision, and in the expenses he would write it off as a bad debt. So this was creating the expenses also. He was showing the net profit correctly. Okay, he was showing the net profit correctly, but he was inflating the sales and the expenses by provision and bad debts. So then we corrected those numbers and presented. So this is what is comparison of non-financial information and financial information. So outside in the market, because of the change in law, there is increase in sales for 2-3 months. Yes, very much valid. It is understandable. But when the law was changed or subsequent amendments happened, obviously the numbers should drop back to the normal levels, or some drop should be there. But the drop was not happening. So this is what is comparison of the non-financial information. We did not compare with sales, we did not compare with balance sheet, we did not compare with P&L. We compared with some news available in the market, just like how we are comparing the Hyundai scenario. A tweet, which is a non-financial information, can now be compared, can now be said to be the cause for a financial impact. Next, what exactly are the analytical procedures that we need to carry out? First, determine the suitability of particular substantive analytical procedures. In that first one, substantive analytical procedures more suitable to large volumes of transactions tending to be predictable over time. So like I said, sales and material cost compare பண்றது, sales and total assets compare பண்றது, sales and net assets compare பண்றது. These things will give you some ratios which can be compared over large period of time. Salaries being 30 to 50 percentage of the sales. These things are over a period of time. You can say that was material cost on the last 10 years pata, it is in the 46 to 50 percentage range. But in the last 5 years, if you take, it is in the 96 86 to 90% range. And in the last 5 years pata, it is in the 88 to 90% range. So that is giving you a sense of direction. That is telling you that was the cost is increasing, but the sale is not able to increase along with it, isn't it? So that is giving you a sense of the total data that you have. So ideally, analytical procedures, substantive analytical procedures are more suitable to large volumes of transactions. Because in large volumes, what happens is the deviations gets normalized. In small volumes of data, what happens is even a single deviation creates a big fluctuation in the ratio. But when you take a large volume of data, most of the times what happens is the individual deviations get normalized. Even if those numbers have deviations, even if those ledgers have deviation, they get normalized because the data that we are dealing with is huge in numbers or huge in quantity. Next, suitability of analytical procedure is also influenced by the nature of assertion and the auditor's assessment of analytical procedures effectiveness to identify the mistake. So you cannot always apply the same analytical procedures to all the aspects of the organization. When you are analyzing the stock market price, when you are analyzing the stock price of an organization, you also need to deal with the non-financial information. You cannot just say, okay, கம்பெனியோட இன்ட்ரென்சிக் வேல்யூ இவ்வளோ இருக்கு, கம்பெனியோட பிரைஸ் ஸ்டாக் மார்க்கெட் பிரைஸ் இவ்வளோ இருக்கு அப்படின்னா, you cannot just simply compare and say this is the value, this must be the price. Okay, you need to see why this entity is not performing or why this entity is performing so well. What is causing this? There is a charming CEO at the top, there is a very public figure at the top, there is a reputed organization behind this particular entity, there is something that is the product has a very unique structure, the sale is driven by very uniqueness in the market. So these things are non-financial information which can really guide you in understanding certain information. So when you're talking about auditors assessment of analytical procedures effectiveness to identify material misstatement, most of the times when you're taking something like stock prices, you cannot compare purely with financial information and say this is what is my EBIT consistently, this must be the stock price under the one. You cannot always do that direct comparison. So analytical procedures one, it depends on what kind of line item in the financials you are reviewing. When you're taking operational cash flows and seeing what are the changes in inventory, what are the changes in receivables, those things you need to analyze it in relation to the sale, in relation to the market prices. You need to see how exactly the per ton, per kg, per unit value changed in the market. How are how is this company able to get those changes into them? So what exactly are the changes that happened? So cash flow analysis பண்றது இதெல்லாம் வந்து it becomes one type of analytical procedure for these current assets. So working capital analysis பண்றது, all these things will be effective for that particular group of line items. So for a different set of group of line items, you need to use different set of analytical procedures. So for you cannot use the same analysis for current assets as well as fixed assets. Fixed assets, there is no point comparing them to the sales. Fixed assets, you need to try to see and compare them with the equity. You need to try to compare it with the total assets. You need to try to compare it with the liabilities. There it makes more sense because you have so much of assets which are substantiating this much of liability, this much of equity was bought in, and this much of assets were purchased through equity and through debt. This much of assets are there in the organization. The company is running more on the current assets, company is more running more on the fixed assets. இதெல்லாமே வந்து it makes more sense when you're taking fixed assets analysis. But when you're taking current assets analysis, comparing them with equity, comparing with them with the total liability does not make sense. You need to compare them with current liabilities. That makes more sense. You need to compare them with sales. That makes more sense, because the sales is what is converting into the cash. If it is not converting into the cash, it is converting into receivables. That inventory reduction is what is pushing to that cost sale. So the reduction of inventory, the increase of debtors, the increase of cash, all will be in sync with the sales number. So when you're doing this current asset analysis, you cannot do it with other things like fixed assets. So depending upon the line item of the financial statement, the methodology or the type of analytical procedure that you apply must change. So nature of assertion is again based on that. If you're looking at purely the profit and loss items, the nature of assertion differs. If you're looking at the balance sheet items, there the existence is more valid, the completeness is more valid. So the based on the nature of line item that you're looking at, your analytical procedures also change. In some cases, unsophisticated predictive models may be useful. Unsophisticated predictive models அப்படின்னா என்னது? பெரிய பெரிய வார்த்தை. But simple thing is, it is not a generally established procedure. That means you have a random sampling which says go by 1/3. Every third number you take into consideration. That is a predictive model, where sophisticated predictive model, where you have a defined logic set into it and say that this is what I am going to do. But unsophisticated predictive model andradhu vandu, for that particular analysis, for that particular ledger, you are creating your own type of analysis. Okay, now let's say yeah. So think of this. Now there was this wonderful accounting goof up I've seen. This was the most complex accounting I've ever seen in my experience. What they have done is, to show the unrealistic picture to the banks, if you do straightforward adjustments, the bank will figure it out. So what these people have done is, they have posted sales to um, retained earnings directly to retained earnings, and then sales to what is that, receivables, intercompany receivables, also trade receivables. And then from the trade receivables there is expenses that are going. From the intercompany receivables there are some provisions going. This way you will not imagine, they have touched every single part of the balance sheet, every single part of the P&L, every single part of the cash flow statement. So this was like mind blowing, because what they wanted to do is inflate sales. So for 100 dirham, for 100 rupee increase in sales, they have almost created 20-30 entries just to push that number across in all the ledgers, so that if you're trying to do any ratio analysis, the goof up is so large that you're, like I said, when you deal with large volumes, the deviations tend to normalize. So if you take only singular and see, it will definitely give a significant deviation. But when you take large scale of volumes, the deviations tend to normalize. And these people have done some 20-30 accounting entries just to increase the sales by so much number. So this, even when we did the ratio analysis also behind that, it was not giving us any deviations. But when we actually checked the ledgers, we were checking the ledger for some other purpose, and saw some entries which were not in line with, or they were very, like exactly 5 lakh, exactly 1 lakh, exactly 50,000. So like that, we were just trying to add them up and realize this was done for the banking purpose to project them higher number. These people have done these entries. So in such cases, how do you really analyze? You cannot sit and remove this number from everywhere, right? You cannot definitely remove this number from all the ledgers, and you cannot try to reverse all the 20-30 entries and see what is the actual impact. So that may be little difficult, because the entries were made in such a way that it is like having an impact everywhere. Now, because of this, what we had simply taken is, we had taken what is the actual increase in the sales, and then try to reduce that number from all the balance, the assets, the liabilities, and the sales, and the retained earnings, the net assets. So from all these areas, we have reduced the number, and we had tried to test it, and then the results were as normal as the previous period and previous quarter. So this is what is an unsophisticated predictive model, where you don't follow the regular scheme of things. You try to define your own analysis for that particular instance, because it requires a more specific set of things to be analyzed for, based on the particular set of given circumstances. Next, they say different types of SAP, that is substantive analytical procedures, provide different levels of assurance. What is assurance? Assurance is the true and fair view that we are giving to the end users of the financial statements. So for us to give them assurance, we need to get our assurance, right? That is why we are doing the audit. And depending upon the type of analytical procedure that we apply, we get different levels of confirmation, or different levels of satisfaction, different levels of assurance. If you remember, all these days I was using the word satisfaction. More than the word confirmation, I was using the word satisfaction to the auditor. So the reason I was using that was because I didn't want to use the word assurance. Assurance is actually what is called as the audit. ஒரு statutory audit இருக்கு அப்படின்னா, even in the big four and all, it is simply called as assurance division, because you're trying to give assurance to the stakeholders that there is a true and fair view. Okay, the statutory audit itself is called assurance audit. So what is assurance அப்படின்னா, you are trying to give them a true and fair view. When you are giving them a true and fair view assurance, you need to be assured first. So for you to be assured, you are carrying out all this audit. And depending upon, like I said, explained, for financial the what is that, for stock price, you have to do one kind of analytical procedure. For fixed asset, you need to take up one type. For current asset, you need to take one type. For indirect expenses, you need to do different types of analysis. So based on that, you can have your understanding. So based on the type of analysis also, like I explained, ratio analysis is one thing. Then there is 5% analysis. 5% analysis will give you an understanding as to why the sales has increased, why the sales has decreased, or overall view. Ratio analysis will give you how this number has moved in comparison with the other number. So you can take this Benford's log analysis and say, okay, there is something wrong with the accounting entries that are starting with the number 2. You try to pull out the general ledger and see all those accounting entries that are starting with the number 2. Okay, so then you will try to filter out the material entries and see if there is anything that needs to be analyzed further in those entries. So all those things, based on the type of analysis you do, obviously the type of result will vary. Next, Particular SAP substantive analytical procedure may be considered suitable when test of details are performed on the same assertion. So more test of detail, that is, you have the document, but when you perform analytical procedure, it may seem more viable. Straightforward example is depreciation. More than the accounting entry, what you need to see is whether the percentage is matching or not. When you see the percentage check, that is directly helping you understand whether the accounting entry is correct or not, isn't it? So these are the things you need to take into consideration to determine the suitability. How exactly to put forth those analytical procedures and what analytical procedures to be applied. This is something that is first determined then. So evaluate the reliability of data. Before you do the analysis, you need to first determine the analytical procedure that you're going to apply. And second, you need to see whether the data is reliable or not. What is the factors that are going to affect the reliability under the One, the source of the information available. Like you have read in audit evidence, external data can be more relied than the internal data. Internal data can also be relied if you are very confident about the control effectiveness in the organization. So audit report is more reliable than the internal report, isn't it? So the source of information, where is it coming from? Is it audited? Is it verified previously? Has the internal audit happened? Are the controls effective? All these things matter. Then the comparability of the information available. With respect to the source of information, you can also think of the software. Let's say you take trial balance from the Tally, trial balance from SAP, trial balance from QuickBooks. QuickBooks under the actually it is not something that is suitable for Indian scenario. QuickBooks under it has been designed or modified slightly for Indian circumstances, but it is not very practical for Indian scenario. So as soon as you see that the company is using QuickBooks, you need to have that in mind. Okay, this is not very suitable to the Indian, accounting system and legal requirements. So should I completely take reliance on the trial balance that is coming out of QuickBooks? Another or analysis நீங்க பண்ணிக்கணும். But if you're talking something like Tally, if you're talking something like SAP, they are established in the market with a very large scale reputation. So that will definitely give you a confidence that okay, boss, these things are already there, very much established in the market. So I think this can be a reliable data. Or in the past, has there ever been a situation where you were forced to doubt the reliability or integrity of the data being provided to you? Is the data that is extracted from the system matching with the system or not? The Excel that is provided to you and the numbers that are there in the system, are they matching or not? All these will generally determine the reliability of the source information. Next, comparability of the information available. Is it comparable? Is it documented? Is it audited? Is it verified internally? Is it approved internally? All these things make a difference. Next, nature and relevance of the information available. Again, fixed assets, the type of the line item that you take or look into the financial statement depends, contributes towards the analytical procedure that you are going to select and the data that you are going to read. Next, controls over the preparation of the information. By default, everywhere the IFRS talks about it, the Ind AS talks about it, the Companies Act talks about it. Everywhere the auditing standards talk about it. Everywhere it is the same thing. Internal controls are very, 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 very important. So if a company has effective and efficient internal controls in place, then there is higher reliance on the data that is coming out from that organization. So you have determined the analytical procedure that you're going to apply. You have evaluated the reliability of data. Now they are saying develop an expectation of recorded amounts of or ratios and evaluate whether the expectation is sufficiently precise to identify material misstatement. Like I said, auditor's expectation. So you will have one, based on your experience, you will have one idea of that number. If that number is matching your analysis, if that number is matching your senses, then you can proceed with it. Otherwise, you need to dig deeper for any probable material misstatements. Determine the amount of difference of any difference of recorded amounts from expected values that is acceptable without further investigation. ஒரு 5% analysis இருக்கலாம், ஒரு budgeted analysis, budget versus actual இருக்கலாம், budget actual versus forecast இருக்கலாம். All these areas, if it is within the 5% deviation, okay, you can ignore. But if it is more hitting 5%, or if it is more than 5%, then that area is something that you may have to look further into. So all these analytical procedures you have carried out. Now you are investigating those analytical results. What are they? If auditor identified fluctuations or relationships that are inconsistent with other relevant information or differ from expected values by a significant amount, either materiality or lack of control, both will help you understand whether we need to carry out or go any further. Okay. So how are we going to investigate those results? One is through inquiring of management. That is, talk to the management and see why these deviations are happening. Like if you remember, I was saying the 5% deviation if there is any plus or minus 5% happening in any part of the financial statement, the Big Four will ask the management will to give their comments over there. Say why there was a more than 5% deviation in this particular line item of the financial statements. So the management has to give a written in writing saying this is what is the reason for that. So in writing, as in it could be Excel, it could be Word, it could be anywhere. So first inquire with the management. Otherwise, you try to perform your own. Not just otherwise, you also need to perform other techniques, other procedures, or other audit procedures and others. analytical procedures to see if there is any further digging that is required of you. So till the above, they were trying to help you figure out what is the analytical procedure to apply, on what is the criteria that you need to take into consideration for figuring out the analytical procedure to apply. Then when you are applying the analytical procedures, you are applying them on the data. So you need to ensure that the data is reliable. Then you develop an expectation. The expectation is something that is very, very important because it gives you a sense of the numbers. And then determine whether the differences are acceptable without further investigation. If not, if those deviations are not acceptable within acceptable range, then you go for further investigation. So, what is the investigation that you shall do? First is talk to the management because they are the ones who are the owners of the company that you are auditing. They will know what exactly is the reason, irrespective of whether they are doing the fraud or not. If you take it to them, what happens is, based on their reactions, based on how they are responding, you will get a sense as to what exactly is happening, whether we need to dig further into this or not. அதெல்லாமே வந்து you need to take into consideration. So there is this particular accountant which we deal with. He always gives one reasoning to junior level, and when a senior level comes and questions him, he will give a different response to them. It will be completely different. So this is something that is very misleading, right? Because the junior will be the one who will generally carry out the audit, and for them he will give a very normalized reaction. But when a senior comes and asks him, he will openly tell what is the reason. So the junior will be carrying out the analysis based on whatever the information they receive, isn't it? But when the senior comes, the whole scenario itself changes over there. So with respect to that particular employee, we always try to deal at the higher level because they don't otherwise open up properly, which may unnecessarily consume our time and efforts. So based on the numbers we are dealing with, based on the people we are dealing with, you need to decide whether the further investigation is required. Talk to the management and see if there is any requirement for further analysis. And that is your analytical procedure standard, SA 520. Okay, so give me a 2 minutes break and we'll start with the next standard, which is sampling. Guys, just go through the standards that we are going through and let me know if you are having any doubts or anything. If there is any doubt, please raise it so that I can sort it out right now. Okay, so I'm guessing there are no doubts. Let me know any standard it could be, but in case you are having anything on mind, just let me. Okay, so we'll start with audit sampling. Audit sampling, where are you? Yes. So, okay. For you guys to okay. I think that we'll discuss later on. Okay. So let's start with something called as audit sampling. Now, sampling is something that is by default carried out in audit. And naturally, this is one of the biggest drawbacks for an audit because you tend to do most of your work based on a sample. When you're taking a sample and doing the audit, naturally, the plausibility or the probability of finding out all the material misstatements reduces, isn't it? So, what we do is we take a sample and say, in the given sample, if we did not figure out any misstatements, then we are giving an assurance that there is a true and fair view to the financial statements. But is it not possible that if in the items that we have not taken the sample, can there not be material misstatements? Yes, it is very, 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 very much possible. So this is one of the basic limitations of an audit, that the sample is something that is causing that. And that is where we come across the word sampling risk. Okay. And there is something called a sampling risk. Since we are taking only a sample, that means we are not taking 100% of the population. We are not taking 100% of the transactions. Just how they were doing with Pfizer, just how they were doing with COVID, what is that? Vaccination. You cannot test all the population and see what will be the effects on the people, what will be the thing. They had to take test runs, trial runs, closed lab testing, experimentation to see if it will work. They have very short period. They had a very short period of time, and this is the fastest vaccine was ever developed for any virus in the world. The previous virus that affected on a large scale, it took nearly 10 years to find the right vaccine for the virus. But this coronavirus, they had to test on a limited number of people and hope that this will be suitable for the majority of the population. That is the best they could do because of the need for faster reaction. Otherwise, the world was on the verge of collapsing. So, at one point, WHO said even if one person has corona, the entire world is at risk. That is the level of risk that this vaccination carries. So, in that case, they had to do with the sampling. So, sampling is something that is not, always on a negative end. It gives out a good result for us, provided there is a standard way methodology in which we apply this sample and we document that sample. The documentation of the sample is also important. So let's look at the standard first. Meaning of audit sampling. Abdina. Application of audit procedures to less than 100% of items. Less than. Sorry, the symbol வந்து எப்படி less than greater than எப்படி சொல்ல முடியும் அப்படின்னா இந்த நம்பர் பாருங்க. இந்த நம்பர் பார்த்த உடனே இந்த டாட் பாருங்க, லெஃப்ட் சைட்ல இந்த டாட் where the two arrows are meeting, that is smaller side. In the open side is where the greater side is. That means 100 is the greater number here, and the dot on the arrow marker or point one, that is the lower side. So since the opening of that arrow is towards the 100, it means the 100 is the greater number. Here if you see the pointed type or the arrow or a point on the 100 side la irukku, that means other numbers are greater than 100. So 101 is greater than 100. 100.01 1 is greater than 100, 120 is greater than 100, 1200 is greater than 100. So this in the opening வந்து எந்த பக்கம் இருக்கோ அது வந்து it becomes the greater side. Here is they are saying this அப்படின்னா this you are talking about the point is towards 100. That means you are talking about something which is greater than 100. Here we are talking about something that is less than 100. So whenever you're taking something less than 100, it becomes your sample because you're not taking all the line items. So sampling or a definition is very simple. Less than 100 percentage population, if you take, it is a sample. What are the types of sample that you can select? One is statistical sample, one is non-statistical sample. Statistical means there must be a mathematical logic behind it. Non-statistical means you simply decide based on some random theory or some random activity. ஒரு காயின் டாஸ் பண்ணி இந்த டிரான்சாக்ஷன் எடுக்கணுமா இந்த டிரான்சாக்ஷன் எடுக்கணுமா ஒரு காயின் டாஸ் பண்ணி we are doing that ledger at this ledger. This becomes a statistical sample because you're deciding based on a logic or a coin toss, and based on the end result of that coin toss you are deciding the ledger to be verified. It becomes a statistical sample because there is a 50-50 percentage chance of that both the one of the ledger gets selected, isn't it? So there is a logic behind it. But non-statistical sample எப்படின்னா நம்ம இது எடுக்கிற மாதிரி ஒரு தட்டுல இருந்து இந்த what is that from a basket of apples picking out some apples அப்படி இருக்கும். So there is no logic to it. You just pick whatever is coming to your hand, isn't it? So there is no mathematical analysis to it. There is a logic that whatever comes to your hand you pick it, but there's no mathematical analysis that you do, isn't it? But if you put all the apples and say I will take whatever is weighing more than 100 grams andra mari or a particular analysis panna, it becomes your statistical sampling. So let's look at it. It says an approach to sampling that has the following characteristics. First, random selection of the sample items, and ரெண்டு characters may இருக்கணும் because there is a and over there. This and is important. Random selection இருக்கணும், அதுக்கப்புறமா there must be a probability theory. You should use the probability theory to evaluate the sample results. So what is that? Let's see. Random selection of the sample items. So if you remember one of my previous classes, I specifically told you random does not mean random. Random means a sample which has a particular logic behind it. %30 of the items or every third line item in the ledger or every first Monday transaction. So all these things, though the outcome is random, there is a clear-cut logic behind them. Though the outcome is random, there is a clear-cut logic behind that random outcome. So that is why it is called as random sampling, because the outcome looks random, but there is a logic in the selection process. The way in which you select that sample, there is a logic, but the outcome is random. And the use of probability theory to evaluate the sample results. So what is the use of probability theory? என்ன பெரிய பெரிய வேர்ட்ஸ் எல்லாம் யூஸ் பண்றாங்க அப்படின்னா what the probability theory says is, இந்த sample வந்து நீங்க analyze பண்ணீங்க, okay, you are analyzing the sample. If you don't find any deviation, what is your analysis? இதுல வரல அப்படின்னா 100% ஆஃப் த பாப்புலேஷன்லயும் எந்த மிஸ்டேட்மெண்ட்டும் இருக்காது என்ற ஒரு அனாலிசிஸ் தானே நம்ம ஒரு அசம்ஷன் தானே பண்றோம். So that is what is your probability theory. So what it says is, if this sample is not affected by any material misstatement, the probability that 100% of the sample is also not materially misstated is a probability, is a factual possibility. Okay, if this sample is affected by material misstatements, then the probability of the 100% of the sample being affected by material misstatement is also equally higher, isn't it? So that is what is the probability theory. It's not a very big thing. It simply means that if the sample is affected by the material misstatements, then there is a probability that the entire population is affected by the material misstatements. If the sample that we have audited, we could not find any observation, then there is a probability that the entire 100% is not affected by the material misstatement, but we cannot rule it out since we have not audited the 100%. And that is why they have included the next line, including the measurement of sampling risk. Just because we have applied the probability theory and said that the material misstatements are not there in the sample, so they must not be there in the 100% population under the one, it is not practical. So we considering the sampling risk, we need to say that just because there is no material misstatement in the sample, there is a higher probability that it is not there, the misstatements are not there in the total population also. But we cannot rule out the relevance of other misstatements, relevance or existence of other misstatements. So next one, what is a non-statistical sampling? So a sampling approach that does not have characteristics of random selection and use of probability theory is considered non-statistics. This makes more sense because so that you don't get confused. So it neither uses random sampling. Random sampling means a mathematical logic must be there. So there is no mathematical logic, and then there is no probability theory application over there. You try to define the sample based on your own analysis, based on your own understanding of those transactions, or your own understanding of the entity, your own understanding of the ledgers. There is no proper logic behind the sample. You go based on your senses. You go based on your feeling. Your feeling is driving you. In those cases, it is generally a non-statistical sampling. Next, sampling risk. Sampling risk என்றது வந்து, what is that? First, risk that the auditor's conclusion based on the sample may be different from the conclusion if the entire population was subject to the same audit procedure. So like I said, 100% audit பண்ணா ஒரு அனாலிசிஸ் வந்திருக்கலாம், sample audit பண்ணா ஒரு அனாலிசிஸ் வந்திருக்கலாம். The assurance itself would have changed if we have done 100% audit. The assurance that we are giving for a sample and the assurance that we might be giving for 100% of the population might be different. So for this, they are giving you indicators that test of controls la pathina, if the controls are less effective than they actually are, அப்படின்னா test of details ல வந்து material misstatement does not exist when in fact it does. That means if the controls are less effective, then they are giving you a warning. They are giving you a warning, clear cut warning, saying if the controls are less effective, that means material misstatements detection becomes difficult. Detection is also less effective. So just because you did not find them does not mean they do not exist. Okay. Since the control effectiveness is low, there is a higher probability of material misstatement. And since the control effectiveness is low, just because you did not find any misstatement does not mean there are no misstatements. So what is the result of this? Affects audit efficiency as it would lead to additional work to establish that the initial conclusions were incorrect. So like I said, if the controls are not very effective, it does not mean that the material misstatements are not happening, or just because from the sample that we have audited, if there are no material misstatements, it does not mean that all the misstatements have been eradicated or identified. There may be possibility of further misstatements. So do we need to do further audit? Do we need to take a further sample? Do we need to scrutinize more line items? That decision is left upon the auditor. So so naturally it affects the audit efficiency, knowing that there might be something out there. That is what will establish whether there needs to be a further sample or there needs to be further audit procedures conducted. Next is controls are more effective than they actually are. Controls are more effective. Adepadi. How is it possible that a control can be more effective? You put a verification in place for something, but it is actually without the company's knowledge, it is helping in some other thing. Let's say one document was one day required to be audited were signed by a purchase department head, and the purchase department head is not there. So some other department head, the finance department head was signing that document. Now the finance department head has a different set of perspective when looking at those numbers, when looking at those details. So they started asking questions and they figured that something is wrong in the organization. So what was supposed to be a regular operational aspect, but it is giving you a dual benefit. It is giving you some extra benefit in controlling any fraud or any leaks from happening. Ways are those controls which are more effective than they actually are. So in those cases, what happens? Material misstatement exists when in fact it does not. So நம்ம வந்து audit பண்றப்ப we have assumed, or we based on the sample that we have tested, we have come to the conclusion that there is some material misstatement. But what you need to keep in mind is that the controls are highly, extremely effective in this particular instance. So whatever misstatement that we have figured is most likely not a misstatement under or possibility அப்படின்னு சொல்றாங்க. So what is the result of that? Affects audit effectiveness and is more likely to lead to an inappropriate audit opinion. So where the misstatements are not there, we have assumed that it is a misstatement, either because we have understood the control wrongly or we have understood the misstatement wrongly. Okay, or we have understood the observation wrong. So in such cases, you need to revisit your audit opinion and see whether it is practically possible. in spite of the control risks in place, in spite of the sampling risks in place, the test of controls also has a major impact. If the controls are less effective, then there is a possibility that we may not identify the misstatements that are supposed to be identified. So based on that, we may have given a statement saying it is true and fair view, but in fact it may be a different scenario. So whether to carry out those additional procedures or not, since you know that the control efficiency is low, control effectiveness is low, you need to determine whether further audit procedures needs to be carried out. Similarly, they are warning you where the controls are very effective, where the same thing is checked by multiple people, where the verification for that particular product happens at different levels. There is a quality check at the supplier before the supplier is supplying the goods. The quality check happens. After receipt of goods, the quality check happens. Before going into the production, the quality check happens. After coming from the production, the quality check happens. So many levels of quality check just to ensure a wrong product or a defective product is not going out. That means this control is highly effective. In those cases, if you find out any misstatement, there is a highly likely possibility that your observation is wrong. So that is what the standard is warning you, that the controls are highly effective. Just be double sure that your observation is not incorrect. Okay. So if you give audit opinion based on that incorrect observation, obviously you will be in soup because people will laugh at you. So your audit opinion might be inappropriate. So revisit that and try to correct it. Next, when it comes to a sample size, what are the things that you need to do as an auditor? First is the design. What is the type of random sampling to be done? What is the size of the sample to be done? And how do we select those items? And they are saying or talking about three aspects. Yeah, they're talking about three aspects. First, while designing, consider the purpose of the audit procedure and the characteristics of the population. First, let us read all the three and then come back. Sample size should be sufficient to reduce sampling risk to an acceptably low level. So this is one of the very basic assumptions of auditing, that though you are conducting the audit, there is practical possibility that there is a risk that is existing in the financial statements that we are presenting. But by removing the material, we keep coming across that by removing or eradicating the material misstatements, what we have done is we have retained only the immaterial misstatements. That means the risk has been decreased from high to low. Even we accept the fact that there is possibility of misstatements, but because of the audit, what we can say is at least we have removed the material misstatements from the financial statements. At least we have ensured that the material misstatements are not there in the financial statements. So what is left is only immaterial misstatements. There are mistakes, but they are not material. They are less in value or less in impact on the whole organization. Selection should be in such a way that each sampling unit in the population has a chance of selection. So they are saying preferably always go with the statistical sampling. When you go with statistical sampling, there is a equal chance for each sampling unit to be selected in the population. When I say one third of the population, I'm giving an equal chance for all the population based on the sorting method that we use, based on the amount sorting, date sorting, or based on the transaction sorting, whatever it is. I'm giving an equal chance for those line items to get selected. Every third line item will be selected. So which third, we don't know, isn't it? So we are not altering anything. We are not, specifically modifying the results for modifying the ledger for a beneficial purpose. Whatever the ledger is, we are taking as it is and saying we will select every third sample, every second sample. So we are giving equal chance for every single transaction to be selected. Okay. Next, so come back to the first point. While designing, consider the purpose of the audit procedure and the characteristics of the population. If you are auditing a depreciation account, by default, you don't need to do sampling, please. By default, you don't need to do sampling because you already know what is the percentage to be applied, isn't it? So if you can just look at the ledger, it is a 5-minute job to carry out the depreciation workings, isn't it? You just need a 5-minute job to analyze the whole year's worth of data, to analyze what is the depreciation for the entire year. There need not be sampling for entries like depreciation. So you know all the 12 entries that are supposed to go into the ledgers. And if the 12 entries, the total is not matching, then you can take it into consideration and see where things are going wrong. So based on the characteristics of the population, you need to define what is the sample that you are going to take. Let's say a new product has been launched. Take a higher sample. It is the regular product which has been continuously being sold since the last 5-10 years. Take a regular sample, 30%, 40%, 50%. Take that sample, do the audit, be done. But if there is a new product, take a higher sample so that you are confident that there is low number of misstatements. So depending upon the characteristics, you consider also the audit procedure and the characteristics before determining the sample that you are going to take, or sample methodology that you are going to apply, or sample design that you are going to do. Next, like I said, sample size. By default, we all accept that the risk will be there in the financial statements. So our duty is to ensure that the material aspect of it is reduced. We give an assurance that the material misstatements have been eliminated from the financial statements. The immaterial financial misstatements might still exist and continue to be prevalent, but it is low in impact and nature. Third, the selection of the sample should give the each unit sampling unit to have equal chance of selection. So when you are pulling out from a box, that means you are giving equal chance to all the units. You may pull any particular unit from a box. It's like that. So there should be a equal chance that you need to give to the sampling units. That chance is more equal when you are defining a proper logic. When you are choosing a statistical sample, you give it a proper logic. And the standard very specifically recommends use of statistical sample and not to consider non-statistical sample for the purposes of audit, because there is a mathematical logic established behind the statistical samples. Now that you have designed the sample, selected the sample, identified the sample. Now we do the audit procedure. Perform audit procedures appropriate to the purpose on each item selected. So naturally, we will carry out the audit as per the other standards. Next, if the audit procedure is not applicable to the selected item, perform the procedure on a replacement item. Please mark this. So what does this mean? What is a replacement item? What they are saying is, let's say you have taken 10 transactions, and out of them, 2 transactions, the manager was not there during that time. So the manager did not sign, someone else signed on that. So what you need to do is replace those 2 transactions with any other transactions in the ledger and try to figure out if they are being proper or not. So for example, I will share one Excel. So let's say these are the samples that we have in front of us. Now these samples, we are saying every third line item. So I'm taking this into consideration and applying some logic, okay? Some mathematical logic I'm applying. So I will take all the twos அப்படின்னு வச்சுக்கோங்க. So this is the sample that I have selected, okay? So this is the 100% of the population. This is 100% of the population. This is the logic I applied. Now this is the sample and this is the logic. Now we need to take only the twos, right? So remove this thing. So we have filtered out only the twos and taken this as a sample size for our purpose. So let us assume out of the 30 transactions, I have taken 10 of them. So that is your 30%, right? 10 by 30 is 1/3, that is your 30%. Now, what has happened is, let's assume all of them were signed by the manager except this. This is an exception. These two were an exception. The manager was not well on those days, and these two were an exception. So, what the standard is saying is pull out these numbers, audit them separately, but find a replacement. Find a replacement. So instead of this 20, try to take 21. Take a 21 instead of 29, maybe take a 31. So you see, you have taken a replacement item because we have decided that we will keep the sample size at the 30% of the population. We need to audit 30% of the population. So because of that, we have taken the exceptions out and replaced them. In case we are replacing them, we need to see whether these replacement items also follow the logic of the other items that we have taken into consideration. Now, What do we do with these exceptions? What do we do with these exceptions, Abdina? We need to audit them separately, because most of the cases, these are the deviations. In these deviations, if there is anything, we need to see if we need to take a higher sample. Okay. So if these replacements concept you understood, right? Because there is an exception from the 100 percentage of the population, you have to pull out some other numbers and replace them, so that your sample that you want to consider remains the same. The 30 percentage of the sample, it is remaining the same. And then you pull out these exceptions and try to look at them separately. You audit them separately. You see why they are an exception. You try to figure out what other procedures can be applied to them. So let's come back to where we were. Say 530. So first, select the replacement item. After that, if the auditor is unable to apply designed audit procedures to the alternative or the alternative procedure to the selected item, consider that item as a deviation. So for the exceptional items, we have to audit them separately, see if there is any particular deviation that is arising out of them. So in case there is a deviation, you then need to decide whether you have to increase the sample size or whether it is a one-time exception, what exactly caused those deviations, all that you need to do the analysis. So understand carefully, first select the sample, identify the exceptional items, pull out those exceptional, try to replace the exceptional items with something from the main population. Now audit all that population. Whatever observations are there out of that regular population, you will have some observations. And then come to the exceptional items. These exceptional items, you need to take additional care in ensuring that these things don't carry any material misstatements. Now, if you end up finding any material misstatement in these exceptional line items, then you need to apply that concept to the entire population or some extra population to figure out whether these exceptions are there only in these two line items or whether they are there in a higher population. And accordingly, your observations will vary. So finally, evaluation of results of audit sampling. So once you have the results, that is what I was talking about, to determine whether the use of audit sampling has provided a reasonable basis for conclusions about the population that has been tested. So whether you are able to make any reasonable conclusion out of it. So it is not just a conclusion, it has to be a reasonable conclusion. A reasonable basis should be there, a reasonable conclusion should be there. When you are trying to give a assurance, there has to be a reasonable basis of selecting the sample. There has to be a reasonable basis of arriving at the conclusion. If the sample has a risk, you may have to apply it to a higher population. It is not always compulsory that we have to stick to the 30%. If the 30% has deviations, you then determine whether you want to take a higher percentage and see if it is still holding true, or you want to take 100% of the population. So sometimes it also depends upon the characteristics of the population. Some things like amortization, depreciation, rentals, lease payments, EMIs, bank charges, these things you don't have to take sample. You have the direct data with you. You just need to add them up. You just need to divide them. You need to see whether it is matching up to your expectations. So that is what is the evaluation of results of audit sampling. My mouth is going dry, so just give me 5 minutes. I will try to start the next standard. Within this, try to analyze the previous standards on this and see if you have any further queries. Okay, I'm facing some trouble with my throat. I'll see if we can continue the class. We'll take for the next 10-20 minutes and see if we can close the next standard. So we are done with 510, 520, 530. Let's start with 540, which is accounting estimates. Where is the standard? Standard. Yes. So here we have something called as accounting estimates. Auditing accounting estimates, including fair value accounting estimates and related disclosures. So estimates are something that are having some logic behind them. You cannot have just random estimates coming into the financial statement. So there must be some particular logic to them. And that is what we need to take into consideration as an auditor. So for us to establish whether there is a logic behind this or not, we need to follow certain practices. We need to see whether the management has followed certain practices. And that is what we are going to establish through this audit standard called SA 540, which is auditing accounting estimates. And then there are fair value accounting estimates as well. There is normal accounting estimates, then there is fair value accounting estimates. And also their related disclosures. Because if you remember, in the accounting standards, the estimates have a separate standard and they need to have separate disclosures in place. First, what is the objective? What are you trying to achieve with this standard? What are you trying to achieve with this auditing standard? To obtain sufficient appropriate audit evidence whether accounting estimates, including fair value accounting estimates, are, are reasonable and related disclosures are adequate. From a logical perspective, is the estimate reasonable? From a disclosure perspective, is it adequate? That is what we need to establish through this standard. So first, let us understand what is an accounting estimate and what is an estimation uncertainty. What is an accounting estimate and what is an estimation uncertainty? What is an accounting estimate? An approximation of monetary amount in the absence of precise means of measurement. That means it does not have an invoice. It does not have a document. It does not have a contract. There is something that is happening behind it, which we only have to guess through an estimation. We do not have something solid for us to arrive at a conclusion that this is the number. So this is the term used for an amount measured at fair value where there is estimation uncertainty. So let's read it again. An approximation of a monetary amount in the absence of precise means of measurement. நம்மளுக்கு வந்து ஒரு ஃபிக்ஸ்டான ஒரு டாக்குமெண்ட் கிடையாது which is telling us that this is what should be the final value. So instead, we are using some parameters to arrive at that number, to arrive at that estimate. Now next, it says this term is used for This term is used for an amount measured at fair value. where there is estimation uncertainty. If estimationலயும் வந்து ஒரு uncertainty இருந்தால் it is called as measurement at fair value அப்படின்னு சொல்றாங்க. Now what is estimation uncertainty அப்படின்னா the susceptibility, பெரிய பெரிய வார்த்தைலாம் வருது, but try to figure out the dictionary meaning behind this. The susceptibility of an accounting estimate and related disclosures to an inherent risk of precision in its measurement. Obviously, it is an estimate, isn't it? When it is an estimate, naturally it is subject to a wrong estimation, higher estimation, lower estimation. Coming in the exact range is very difficult. It's like betting and saying Sehwag will hit exactly this many runs in this match. How is it possible? You can only assume based on his previous performance. You can only estimate that this is what he is going to hit, but there is no guarantee that this is what he is going to hit, isn't it? Even the betting games that are there these days, as the game progresses, you try to estimate that this is the runs the team is going to hit, or this is the runs the person is going to hit. But there is no guarantee that you are going to touch that number. Some people get lucky, some people estimate higher, some people estimate lower. So that is your estimation uncertainty, estimating a higher or a lower number, a higher or a lower number than the actuals. When do we get to know the actuals? At a later point of time. But as of the balance sheet date, as of the date of financial statements, we are still not sure about the actual number. So we just have to make certain assumptions for those particular line items. We as in the management, not as an auditor. So if it is higher or lower than that actual, then it is a estimation uncertainty, and every estimate is naturally subject to or susceptible. That means by default, if you are estimating, there is a uncertainty risk. Just like how by default, if you take a sample, there is a sample risk. So just like that, by default, if you go for an estimation, there is a estimation uncertainty. Next, just for example basis, look at this. What are the examples of accounting estimates? Provision for bad debts. Now this is replaced by IFRS 9, which is expected credit losses. Bad debts under the வந்து you just say 5% of the say receivable. Once upon a time, what companies used to do is simply 5% of the receivable they will keep in the bad debts. But now the concept of expected credit losses says each and every single customer, give a risk rating, and accordingly you determine the provision. So just imagine this provision for bad debts is a very vague number. By default, you are taking 5% of the receivable as a provision. But here, when you see, there is a better logic. That means here, every single receivable, you are sitting and analyzing whether this is receivable or not. Whether how much portion of this receivable will be subject to the risk. How much portion of this there is doubt. How much portion of this will take longer time. All that analysis you do, and you give one risk rating. Based on that risk rating, you figure out the amount, and that is how you determine the expected credit losses amount. So naturally, the number that you arrive at expected credit losses is more precise than the provision for bad debts. Okay, it is more precise than the provision for bad debts, but still the estimation uncertainty remains, because whether it is bad debt or whether it is expected credit losses, the number might still be higher or lower than the actual losses. Then you have inventory loss. Inventory loss, we do this net realization or fair value difference. You do the cost or NRV, whichever is lower. We do that valuation, right? That valuation, and then you can think of something like inventory going bad. Some inventory, they don't remain for long period of time, they go bad after certain point of time, they cannot be sold at the regular market value, they have to be sold as scrap only. So that is one of the inventory loss. We can think of market value loss, quality loss, value loss, all of those needs to be bought into the books, because there is a cost incurred, and we know that the receivable will not be accordingly happening because of the quality loss or the price loss. Next, warranty obligations. Now, all the major manufacturers will have this warranty obligation provision. How can you estimate how many customers are going to claim their warranty? It is a very difficult task, isn't it? So based on the quality of the product that you are selling, based on the customer base, based on the method of selling, there is a assumption that this much of the sales will convert into warranty obligations அப்படின்னு ஒரு assumption வச்சுக்கலாம். But we cannot guarantee that this is what is going to be happening. So that is another accounting estimate. Then you have depreciation. Why is depreciation considered as an estimate? Is it a real cash flow? No. Is there a logic behind it? Yes. So similarly, every accounting estimate, there may be a cash flow, there may not be a cash flow, but there has to be a logic behind it. Depreciation, the asset is in use, so you need to depreciate to reflect the wear and tear. Now, what is the right number for that wear and tear is always a question mark. Is always a question mark. Some people say go with the production, where some type of assets produce higher in the initial stages, and the quality and quantity reduces as time passes, because the machine becomes older and it will not be able to take the same loads that it used to when it was a new machine. So keeping all of that in mind, you need to depreciate accordingly. But otherwise, if you take something like building, it's a building. So you can depreciate it in equal numbers throughout the time period. Simple depreciation, straight line depreciation, yes. Otherwise, we may go for a written down value. So all that is depreciation is also an estimate, but there is some logic behind it, just like all the other estimates. Provision against carrying amounts of investments, basically your losses. Estimate. Basically your losses. We estimate that these are going to be the losses against the investments. This is the value that we might lose. If it is tradable in the market, then you can do the fair value estimation. But if it is not traded in the market, then you have to assume based on the information available. Next, we'll also look at the fair value accounting estimates. A means accounting estimates. Examples of fair value accounting estimates: share-based payments, ESOPs, employee stock option plans, share-based payments. These are all fair value accounting estimates because there is a market price associated with those payments, and those payments will be subject to change depending on the date the employee exercises that option. So share option payments and employee stock option plans, all these are basically, you know the price only when the employee actually executes the plan. Sometimes what they say is they'll give the employee a 6-month window and they'll say within these 6 months you can avail the stocks at any point of time. And 6 months is a large number of amount of time because the stock வந்து மார்க்கெட்ல அதோட பிரைஸ் வந்து ஃபிளக்சுவேட் ஆயிட்டே இருக்கும் இல்லைங்களா. It goes up, it goes down, it always constantly fluctuates. So we don't know what would be the exact price on the date on which the employee will exercise his plan. But at the time of making the issue and giving the stock option plan, you make one provision entry saying this is what is going to be the cost for the company and this is what is going to be the receivable from the employee அப்படின்னு ஒரு provision போட்டுட்டு futureல if they are claiming based on the market price you need to revise the provision, or if they are not claiming you need to reverse the provision. Next, assets held for disposal, அதுக்கு ஒரு தனி ஸ்டாண்டர்ட் இருக்கு. India's also has one separate standard for assets held for disposal. So those things you need not depreciate, but you need to value them differently than the regular assets. Next, you have financial instruments. Financial instruments, by default, you have the market price and you can value them at the market value. If you are deviating from the market value, then there has to be some logic or basis for arriving at that. Next is assets acquired in business combinations. Business combinations, they're basically talking about the goodwill. When you are buying assets in the business combinations, that is mergers and acquisitions, takeovers, all that stuff. In AS 108, I guess. Business combination is actually spread across in 3-4 standards in India's. So all these standards you need to take into consideration, and assets acquired in a business combination, you need to see whether the assets are being projected at the appropriate value. What is the final value that is recorded in the books? What are the calculations behind it? What is the goodwill that is accounted? Whether the goodwill calculation is correct? All that analysis goes behind it. So this is basically your introduction to the accounting estimates. You have accounting estimates, you have fair value accounting estimates, and then you have disclosures with respect to those estimates and fair value estimates. So this is what the standard says, that we need to take certain things into consideration because these numbers are not exact. These numbers are estimates. There is some uncertainty associated with them. So you need to carry out certain procedures to ensure there is a reasonable assurance for you. In the standard will tell, so that we will discuss in the next class. Thank you everyone. Have a good day. We are done with the class.
Thank you, sir.
Thank you.